Now we're dealing with adjusting entries. We're not always going to get a receipt or a check, but yet we still have to journalize certain things that occur. And here's the list. One of them is prepaid expenses. If we've prepaid anything at the end of a month or a given period, we need to journalize for the fact that we no longer own this prepaid stuff. So we may have a whole bunch of supplies, we think, but as we use them up through the year, we're not going to have as much as we had before. We have to journalize that as an expense. Insurance, you may prepay it, so it's an asset right now, but as we use it up, it becomes an expense. Advertising, if we've got it prepaid, it's in the bank, it's advertising that people owe us, but as we use it, it also becomes an expense. Same thing as rent. If we've prepaid it, as time goes by, it becomes an expense. We may have collected money from people and we didn't earn it yet. Okay, so that is a liability. We owe them a service. As we provide that service, it's no longer a liability. It has to go away. It becomes an actual revenue. Okay, so we've already got the money in the bank. So money is not affected. We just need to provide them with the service for the money we've already collected. An accrued revenue is revenue that we've probably been working on, but we haven't billed them yet. The opposite would be an accrued expense. We may have people working for us, and they haven't sent us a bill yet. So that's an accrued expense. Like we owe them, but we haven't accounted for the fact that we owe them. So we need to set up some kind of an account saying we owe you this much money, and we've incurred this expense. The last one, as far as an adjusting entry is concerned, is amortization, right? Depreciation. So our stuff, our equipment, our cars may not be worth what they used to be, and we need to account for that. So I've listed here what the ordinary balances are for all of these things. And what we're going to do here is journalize some of them. So let's say that we have less supplies than we used to have before. That has to be now a supplies expense. Okay, so we're going to debit supplies expense, and we're going to credit supplies. We have less supplies than we had. Okay, so that's going to be credited, and supplies expense will be debited. Another example, a month has passed, and our prepaid insurance has been used up. So now insurance expense is debited. Okay, so let's say we paid $1,200 for our insurance for the year. Well, we had $1,200 worth of prepaid insurance. We no longer have $1,200 worth of prepaid insurance. As a matter of fact, we now have paid $100 in expense, and our prepaid insurance goes down $100. Same thing with rent. Let's say we prepaid our rent, and it was $2,400 for the year, to make it real simple. So now a month has passed, so we've got $200 in rent expense, and we have $200 less of prepaid rent. So that account has gone down. We provided the service for which we've already been paid. All right, so somebody gave us some money, and now we're finally providing the service. So our unearned revenue will be debited. So let's say it was $5,000 worth. Okay, so now that goes down, but service revenue, the actual revenue, goes up. The cash isn't affected because we already got the cash. Here we are accounting for services we've received but we've not been billed for. And a good one here is payroll, right? Our employees don't give us a payable for what we owe them, but let's say half their pay period has gone by and they're not going to get paid for another week. You actually have to account for that. So now we need to debit something called accrued expense payroll. So now we owe this staff member $500, and it has to go into the payables of $500. So we now owe them officially $500. There's no cash being transferred. Later, our cash is going to be credited $500, and salaries payable will be debited $500. All we're doing now is accounting for the fact that, yes, we know we owe you that money. Our equipment or our automobile is no longer worth what it was. All right, so that can go down every month, or we might only do it once a year. But for income tax purposes, you want to be able to tell the government that, yes, my car isn't what it used to be, my truck isn't what it used to be, and that can be listed as an expense. So let's say that every year they let you write off 1%. So here, when the time does pass, you'd say, okay, it's worth $500 less this year, so amortization expense goes to debit 500, and our accumulated amortization goes credit 500 as well. So those are the types of adjusting entries you're going to have to do throughout this chapter, okay? And it will help to understand what the normal balances are and what has to be debited and what has to be credited. We're not going to be using cash and accounts receivable as much now, but we're going to be using expense and revenue a lot. And you need to understand that when an expense goes up, it's going to be debited, and when a revenue goes up, it's going to be credited. So if you can remember those two things, journalizing your adjusting entries will be a lot easier. So again, it's expenses, when they go up, it's debit. Revenue, when it goes up, it's credit.